the other lead sponsors that found the deal, they generally have pretty good experience. And now, we have experience as well. But it's one of those balancing things of you do want a general partner team that has a track record, that has experience in that asset class, preferably, in that state or that sub-market. And that's typically who we partner with.
Welcome to the How to Scale Commercial Real Estate Show. Whether you are an active or passive investor, we'll teach you how to scale your real estate investing business into something big.
In the past 2 years, Jeff McKee has become a general partner in over 3,000 apartment units representing $250 million in assets under management in the South and the Southeast. Jeff, welcome to the show.
Thank you, Sam.
Hey, man, the pleasure's mine. Jeff, there are 3 questions I ask every guest who comes on the show in 90 seconds or less. Can you tell me, where did you start, where are you now, and how did you get there?
You bet. So, lifelong W-2 employee, 5 years ago, read Rich Dad, Poor Dad. Then we moved into a single family mastermind here in Austin, Texas, did one fix and flip, one buy and hold, and realized that was pretty hard to scale. And this is my wife, son, and I. Then after about a year of that, we moved into another mastermind that was multifamily based in Dallas. We invested as limited partners in 5 deals. Then we decided we wanted to be general partners. We joined another mastermind group 2 years ago, and we've been general partners on 13 deals, 3,000 plus doors in the South and Southeast.
That is a lot of moving pieces there. And this is a conversation we don't have a lot of talk around. Break down for us the mastermind progression. I mean, a lot of times people join, they'll join a coaching program, or they'll hire a particular mentor. It sounds like the mastermind kind of route was the way that you took this down. Can you break down how you chose your masterminds, and then pivoting out of those, kind of where that decision-making tree kind of broke down along the way?
Sure. Yeah. So I read Rich Dad Poor Dad 5 years ago. Then we decided to start in single family. So the fix and flip, the buy and hold, the homestead strategy. We actually bought a wholesale house and tore it down and built 2 houses on it. We did Airbnb in the back house that we built, and we live in the front house as our homestead. And then, that group was through meetups. And once I got, educated on what I was missing in terms of driving passive income beyond the W-2 job, I said, well, there's got to be a better way. So that was then one of the people in that single family group said, hey, you need to come to a Tuesday lunch, here in Austin, Texas, where we talk about commercial property investing, specifically apartments, syndication, which I didn't know the average person could invest in whatever a syndication was. So there was a lot to learn. So then we went up to a mastermind weekend where they spend 3 days teaching you all about multifamily apartment investing, limited partners. And we joined that group, and then we took some of our capital and put it in 5 different deals. They were all in Texas. And then after a few years of doing that, we said, well, we wanted to go bigger, faster, beyond the 700 doors as LPs. We wanted to be general partners. And then we looked around for another group because we wanted our son to continue investing with us. And the one group that we did the limited partner mastermind, they really wanted him to pay for his own membership to become a general partner. And we went to another group that was much more family oriented. And so we just paid for one membership fee for the whole family. And we have another son and a daughter and that can participate in this as well.
That's really, really cool. What do you feel like the value was in joining a mastermind? Like tell me how the deals were structured. Tell me how the opportunities presented themselves. Can you talk to us about that? Because I'm probably fairly fuzzy on kind of the mechanics of how a mastermind and then taking down deals works.
Yeah. There's all different kinds of masterminds that people can look at, and some of them are small, some of them are large, some of them focus on education, some of them focus on getting you into deals. And there's a few that really focus on getting you in your first deal. And then you've got to figure out yourself, what value do you add? So for example, if you don't have capital, maybe you can find the deal. So you could become an acquisition specialist. Maybe you know something about construction, property management. You could be an asset manager on the general partner team. I didn't really, have those skill sets nor the time, because my wife, son, and I were all in W-2 jobs, at the time. So we focused on the middle part of the syndication, where I can sign as a key principal on some of the loans. I raise capital through this McKee Capital Group.com. And then we also provide earnest money down at risk capital at the front end of the deal. So that's where we added value to a team of people. And that's one of the things I've learned over the years is to specialize, not only maybe in an asset class to be able to scale, but also within that asset class, you need to specialize. It's hard to be a generalist and be very successful. And so the other part of a mastermind is just surrounding yourself with successful people that have experience and that can, help along the way. But then you also add, your unique value proposition to that general partner team.
I've seen mastermind prices range from reasonably affordable for most people to incredibly expensive six-figure masterminds. Can you talk us through kind of the cost to value analysis someone should be making when they look at joining a mastermind group?
Yeah, I mean, part of it is you always hear people say, invest in yourself. So some of this is investing yourself. I mean, we didn't really have much success with the free types of groups that you can join. And so we decided to invest in ourselves and invest in these masterminds. And so the single family one mastermind ranges from like an entry of $20K to $50K, one-time fee, no annual renewing. Some of the other apartment masterminds, multifamily, they could range from 5 to 10K, up to 50K. And usually they've got a renewal fee that is a percentage of that initial fee that you pay that first year. And so that's just part of it. It's a balance of how much capital do I save for my own deal to put in that deal as a general partner to put skin in the game, and how much do I invest in myself and maybe my family if you're investing with others in your family. So that's the balance. And we did a little bit of both, right? We invested on the front end in the masterminds and held back some capital to go then invest in originally as limited partners, then eventually general partners.
How did you gauge that when you said, all right, so, and again, I'm just pulling numbers out here, but let's say you put 20 grand in a single family mastermind group, you did a few deals, and then you say, hey, look, we're going to pivot and do something else. How did you gauge that? And I guess the question I have is, how did you justify it? Because for me, like putting down 20 grand into a mastermind, man, I'm going to squeeze that, get all the juice out of that I possibly can. And then once I feel like I've learned everything I can, then maybe move on to the next thing. But it sounds like for you're quickly, and rightfully so, quickly able to pivot.
Yeah. So the single family was an interesting one because we put the 20K in, we went through all this training, and we ended up partnering with someone that was actually outside of that mastermind group that I had met through LinkedIn. And we did a fix and flip together in East Austin. And the profit before taxes for our LLC and for our partner was $40,000. So our half of that was 20. It was a 50-50. So the 20 actually paid within the first year for that single family mastermind. And then we did some other things about, you buy leads and you're looking for motivated sellers, the whole wholesaling. And that really wasn't for us. We just didn't have time during the day to do a lot of that. So you've got to figure out, where that fits in. But then, after 12 months, we said that was a little bit of work. And so why don't we look to scale? And then that's when I started going to the multifamily meetup weekly. And then we did some training on the weekend.
Gotcha. That's really, really cool. You talked about some of the skills that you bring to a team. One of the things that, we're seeing right now, and maybe I might put my foot in my mouth here a little bit, but some of the deals I see coming across my desk have just, 10, 15, 20 general partners on the team. None of them have experience. And to me, when I look at that, it screams risk.
Yeah.
You speak to that.
Yeah. I mean, we typically in this mastermind that we're general partners, there's always the lead sponsor who founded the group like 8 years ago. He's got, high net worth. He's got, 20,000 doors of experience. And so we always partner with him on these deals. And then there's usually the other lead sponsors that found the deal. They generally have pretty good experience. And now, we have experience as well. But it's one of those balancing things of you do want a general partner team that has a track record, that has experience in that asset class, preferably, in that state or that sub-market. And that's typically who we partner with. But you're right, there are some syndications out there that everybody's new. It's all their first deal. And that can be a little bit risky. Right.
Yeah, absolutely. Absolutely. Yeah. And I think that's just when it comes to especially for the passive investor side of things, that's one of the things I always stress is getting to know first and foremost your general partners. Like that's 80% of your work should be on your GP team. The other 20 is the deal in the market. And then, but that's just my own analysis on that. But help me figure this out. So you're a general partner, but I bet you have some general partnerships with several different makeups of teams. Is that right?
That's right. Yeah, we have some repeat teams and some new teams. Yep.
Right. How do you handle communications on that? Because there's so many seats on the bus and everybody has to fill those seats. So how do you guys decide when you're launching out these various teams, which I too am a general partner with multiple teams, but I want to hear from your side of things, how you guys handle communications.
Yeah, in that particular case, we use Slack once you're part of a team. But before you get to be part of the team, there's usually a private Facebook group, that we got within the whole organization, within the mastermind, saying, hey, I'm looking for someone. I need an asset manager on this asset in this city. I'm looking for some people that have capital and that have the ability to raise capital. So the lead sponsor starts looking to fill out the team, basically. And then we may raise our hands and say, yeah, hey, we've got some earnest money down. We can put at-risk capital up front. I can sign as a key principal on the loan. And then, we can do put in our own money as LPs, but then also capital raise. And so it's private Facebook groups. And then this particular mastermind has a group call every 2 weeks. So we just had one this Monday night. And it's also 15 minutes get allocated to who has a deal that they need help on. So they explain what the deal is, and they've already posted it in Facebook, but they basically are reaching out to everybody on the call. And these calls get recorded for people that can't make it. And so that's how we got into our first deal. My wife had listened to a recording a week after we joined, and then she and my son drove out to Arkansas to this asset to do the due diligence, and we became part of the team. And then we just sold that asset after holding it for 18 months. And so that's how people get involved in these deals.
Got it. It sounds like a pretty well-oiled process for somebody who's new or that wants to get involved. But it's more like a pay-to-play process. You gotta pay the upfront fee to join the group, to understand what's going on, and you got to be able to bring something to the table.
Exactly. I think it's a pay to play, being around others that are generally really successful, experienced. And then you need to have some unique value proposition, whether it's time and you can go find deals, experience with, being a general contractor, an asset manager, a property manager, or maybe you have capital or you have a good network of friends and family that you can, offer these opportunities for them to invest. And so, finding what your special sauce is, what your niche is, and then that's what you can add to the team.
Got it. How do you guys break down general partnership ownership percentages?
Yeah. So we typically do a 70% limited partner, 30%, and we do an 8% preferred return paid to the LPs. That 8% comes off the top before we do any of the 70-30. Then of the 30% general partner allocation, typically it's 20% to the acquisition, who found the deal, and spreading that. Then it's capital raising, 20 to 30%, depending on the deal. It's earnest money down, 10 to 15%. Key principal, 10 to 15%, asset management, 10 to 15%. And sometimes we do consulting, marketing, where we get advice and we bring other people in on the deal to help market it. So it's roughly that range. There's a framework, and then it's adjusted based upon every deal.
Right. Yeah, absolutely. When you're starting out and you were putting down earnest money, you said you were putting down the at-risk capital. How did you know that the at-risk capital you were putting down wasn't going to ultimately end up being risk capital?
You don't know that. Yeah, that's the whole point of at-risk capital. Now, we're moving into a phase where some of these multifamily apartments, you can now do refundable deposits. For the last couple of years, it's all been non-refundable hard money, and you're totally at risk. You put up $100K, $200K, you're totally at risk of losing it if you can't close the transaction. Now, this group that we're a part of, they successfully closed 90 transactions in like the last 6 years. There hasn't been a deal that we've started that we haven't completed the deal, but there are groups that can't raise the capital. They can't qualify for the loan. Something happens near the end of that transaction when they're under the purchase and sale agreement, and then it goes back on the market, and the sellers typically get to keep the deposit money.
Right, which is certainly a scary place to be. But it's interesting to hear, because I'm not in the multifamily space. We're not actively buying there right now, but it is interesting to hear kind of a softening, coming from various sources saying, hey, you know what? Suddenly we can get refundable earnest money, and deals are coming back on market. Now brokers are reaching out to buyers saying, hey, would you like to make an offer? Because, that's, call for offers on multifamily is just not something we've seen for years.
Right. There's probably like 1/3 the amount of active buyers in today's market than there was 6 to 9 months ago. There's also price reductions going on of, 5, 10, 15% on these assets that the seller wants to sell. And the buyers like us are out there doing the underwriting. And because of the interest rate increases, because of some of the cap rates, we have a lower offer price. And so that's the softness you're seeing, in addition to having refundable deposits are starting to come back. And then early access periods to do the due diligence before the formal due diligence, that's starting to come back. So there's definitely, pros and cons of a softer economy. But, we're still net buyers. It's only when we're trying to sell an asset that we've had for a couple of years that we feel the pain if we need to lower the price by 10%, for example. So some of those we may just choose to hold on longer and wait for a little while longer for the rebound.
Right. Yeah, that was gonna be my next question. Has that affected your plans, for disposition? But I mean, again, if you're only a couple years in on a lot of these deals, why not just hold it long term and just keep, clipping that coupon?
Exactly. That's right. And these, typically cash flow from day one, and then we're paying the preferred return. And so it's definitely, you're trying to improve the net operating income through, better revenue management, such as rent increases, as well as better expense management. Typically, we have new property managers we bring in on every deal. And about half the time we rename the asset. And then do the rebranding, focus on the outside improvements, focus on the interior upgrades.
Got it. No, that's really cool. You said that you'd skipped small multifamily entirely. You went straight into the big stuff. Tell me, I guess, what's something you would recommend, or is that something you'd recommend to somebody else if they're getting started? Just go big early on.
Yeah, so that gets back to, if you're more comfortable as a generalist and doing a 10 or 15 or 20 unit apartment building from A to Z, that you might feel more comfortable doing that, having a lot of control, having a large share of the pie. What we decided, because we were, my wife's son and I were still, doing W-2 jobs, we decided our strategy was to go for a small slice of a very large pie. And so the amount of effort that a general partner team takes to do a 20 unit is similar to a 200 unit. And so why not do the 200 unit? And so that was just the strategy. So we totally went from single family to large multifamily limited partner and learned that for a couple of years. Then we went to even larger general partner multifamily apartment deals. And that was just the decision and strategy that we made. Now, that's not to say somewhere down the road, we won't look at doing a tenants in common deal of a 50 or 80 unit deal with one or two other partners. And now that we know what we know, doing it from A to Z. But starting out, we felt like we wanted to be around a mastermind of people. We had a certain area of expertise or value we could bring. And we certainly didn't know A to Z on how to do the whole transaction. So that's where we went large. So it's kind of like the Grant Cardone 10X, add a zero to it. If you're going to do 20, why not do 200? So
love it. I love it. Rewind the tape 5 years, and if you could start over, what would be one thing that you would tell yourself to do differently?
I would say I would have held back more capital as a limited partner to save it to become a general partner and start that process earlier. We were probably in the LP deals for 2 years, 5 deals before we decided to go to the general partner route. I think we did a good job of only spending 1 year on single family, and we tried the one fix and flip. We did the one buy and hold of a duplex in Waco, which we just sold after 5 years a couple months ago. But I think I would have accelerated through the LP and gone to the general partner faster. That's probably one of the lessons I've learned over the years.
Right. Because, as you were given to the breakdown of earnest money, percentages that you get out of a GP, if you're sitting out of a GP stake, if you're bringing the at-risk capital and you're giving 10 to 15% of that general partnership away for the people that are posting that at-risk capital, that's a heck of a much greater return on your money than it would be, say, going out as an LP, even if you 2x your money over 5 years. I think I would imagine that 10 to 15% is worth a lot more.
Exactly. And then that's where during the limited partner training, the lead of this mastermind started teaching, hey, here's the 8 ways you can get paid as a general partner. And we started looking at, acquisition fees, asset management, blah. It's like, wow, we didn't think about that. What would it take for us to go from LP to GP? And then that's where we started focusing our time.
And that fits for you and your particular style. I mean, for a lot of people, my 10-year goal, quite honestly, Jeff, is to be nothing but an LP. In 10 years, man, I want to be shipping Jeff McKee a pile of money and saying, hey, man, just ACH the money in my account. And otherwise, just tell me if there's everything's on fire. Otherwise, leave me alone.
Exactly. Yeah, I do have a lot of people. It's like, hey, I want to be your best limited partner. I have no interest in being a general partner. I'm going to, write the check. I'm going to see, the quarterly distributions and see the disposition. And we'll just keep doing that again and again.
Man, absolutely. I love it though, but you've given a very clear path for someone to scale and to scale quickly. And that fits very nicely within the theme of this show, which is how to scale. And I think, you've given us, join the mastermind, surround yourself with a group of people that know really well what they're doing, find the seat on the bus that you fill, figure out how you can fill those voids, and then just, stay within that ecosphere and grow. So I think that's really, really cool. Thank you for taking the time to come on the show today, Jeff. If listeners want to get in touch with you or learn more about you, what is the best way to do that?
Yeah, the best way is to go to McKeeCapitalGroup.com. You can book time with me there. The other thing is I have a free giveaway on that website, and it's from a best-selling book I was in last year from another mastermind that I joined. And so it's bringing value, solving problems, and leaving a legacy. And so that's a free download, full PDF. My chapter in that book, there's like 40 authors. I'm one of 40. My chapter is about going from single family investing to multifamily investing and scaling. So that's what my chapter. So that's a free download, a PDF on the McKeeCapitalGroup.com, and you can reach that way. Plus, I have weekly blogs out there about multifamily, and people can learn quite a bit from what the content I share.
That's awesome. Jeff, thank you for taking the time to come on today. I certainly appreciate it.
Yeah, well, thank you for having me, Sam.